very warm welcome to all the partners present on this call today. Thank you so much for taking out time and joining the Samco Mutual Fund team on the MFD National Mega Digital Meetup. I have hundreds of partners joining on this call from across the country. I can see people from Gujarat, Rajasthan, UP, Bangalore, Chennai, and a lot of other cities, some familiar names. So thank you once again for joining on this call. And to demonstrate the importance of this digital meetup, I have with me the whole Samco Mutual Fund senior leadership team who would be speaking on this call today, starting with Mr. Jimit Modi, who's the founder and CEO of Samco Group, Viraj Gandhi, who's the CEO of Samco Mutual Fund Business, Umesh Kumar Mehta, who's the CIO of Samco Mutual Fund. Recently, who's joined us, Abhirup Mukherjee, comes with a very good amount of experience in debt fund management. Abhirup Mukherjee. I have Paras Matalia, who's the fund manager at Samco Mutual Fund, and myself, Chirag Joshi, who's the chief growth officer. And on behalf of everyone, all the Samco Mutual Fund team, I take this opportunity to welcome you and thank you for being on this call with us today. Now, I would request Mr. Jimit Modi, founder and CEO of Samco Mutual Fund, to give us the opening remark, and post which we will deep dive into Samco Dynamic Asset Allocation Funds strategy. That is our new NFO that we are launching. Over to you, Jimit.
Thank you so much, Chirag, for the introduction, and thank you so much to all our partners for taking the time out and joining today's meeting. And as Chirag said, it's going to be opening remarks, so I'm going to be I'm going to keep it brief. So first of all, I think at the outset, what I would like to do is I would like to thank the entire MFD fraternity, the entire distribution fraternity for their fantastic support to us throughout our journey. We've had a great 1.5 years that we've been in mutual fund. We are proud to say that we now service over 1 lakh plus folios. We have over 25,000 partners who are now partnered and empaneled with us. And we now manage about $150 million plus in AUM. So our total AUM stands at about 1350 crores, which I think in a short period of 1.5 odd years is a great achievement by the entire team at Samco. And none of this would have been possible without the support of the entire MFD fraternity. So thank you very much. We are very grateful for your support. I think our goal and our mission at Samco MF is very clear. We are here to build, and our mission statement. If somebody has heard of me before, we say the same thing, that our idea is to generate the highest possible risk-adjusted return for investors. So, हम चाहते हैं कि investors actually for a particular unit of risk, at that particular unit of risk, can generate the highest possible return, and that is only possible by offering differentiated, actively but truly actively managed strategies. We've always gone out and said that we don't want to index hug. We will all have significantly different uncorrelated funds, and with that in mind, our entire mindset DNA is built towards differentiated strategies and results. So, and you would have seen that across the 3 equity products that we have delivered, that we have been managing, whether it's the flexi cap where we had a differentiated active share strategy based on our Hexashield model, whether it is the ELSS where we set up India's first and only small and mid cap ELSS, and whether it was India's first actively managed momentum fund, which we launched in June earlier this year. So over a period of time, we've built a niche out for ourselves. We are clear that we want to build differentiation. We want to make sure that we can offer differentiated strategies that other AMCs typically don't end up offering. And that's the objective. And we're trying to optimize on one or two things. So either we're trying to reduce risk for an investor, or we're trying to improve return, or trying to do a combination of these two things. And today I'm really excited to share that, we have one more new offering from our distinctive patterns division, which is again a very differentiated strategy. I think a lot of insight, a lot of hard work has gone into building this in terms of how the models work, etc. So, and I would like to hand it over to the Samco MF team now to sort of walk you through the insights that we have, the problems that the industry faces, and what we are trying to solve. So over to you, Viraj, again, as an opening row, as while concluding my opening note, I'd like to once again thank the entire MFD community, because you all have been the true torch bearers, not just for the industry, but even for us. And your support and your partnership is extremely valuable to us. Thank you. Over to you, Viraj.
Thank you, Jimit. I will also like, with the same note, to thank all of you for being so humble and kind enough to give us the time to hear us out. What I have today for all of us is what I will take you through. So what we are going to do is let's understand what we have it lined up for today. Before we even begin, it's a standard disclosure that throughout the course of the presentation, we might take some stock specific examples. They are neither a buy or sell recommendation, but it is only taken for the illustration of giving an example in a particular manner. So today what we are going to do is we are going to deep dive into the landscape of where the mutual funds were and where they are as on today. What is the category of hybrid doing over the period of time? What is the newer challenges that we have found over there? What is our offering through this particular understanding of this model of dynamic asset allocation that we are launching today? We will deep dive into the complete strategy, what we have formed, which we will be able to deliver to our clients through a transformer model. Then we will show you the results of that particular model. And we will also deep dive you through the drivers of that particular model and what we can offer out of it. And finally, I'll come back again and talk to you about the scheme features and the pricing part of it. So what is that India doing as on today is that we all are aware of. The mutual fund industry in the past decade has gone up by sixfold, from approximately 7.5 lakh crore to closer to approximately 50 lakh crores today. Now, the growth in AUM as a percentage has been phenomenal, but we are still very, very small when we compare ourselves to the developed nation. Most of the developed nation today are on upwards of 60% of average mutual fund to the GDP, where the average is at 60%, but most of the developed nations are above 60%, but we are still at 16%. So despite the sixfold growth in the AUM of the industry, we are still on the lower side of it. Now, India being one of the largest economy, the AUM as a percentage of GDP should have been far higher, is the first point that we are trying to put over here. And when we compare ourselves, what is the biggest competitor to this particular thing is because we are only getting a 1/4 share of the of the AUM that goes by way of bank deposits. So today, when mutual fund industry is closer to 48 lakh crores, the deposit in the bank is closer to 200 lakh crores. So we need to target this particular industry, and we need to bring a growth in the AUM of the mutual fund industry. But the core issue is, why does people still prefer a fixed deposit or a bank deposit compared to a mutual fund product? Is because they believe that when they put their money in the mutual fund segment, it is not safe. They have a bad experience, and it comes because once every 3 years, once every 4 years, our broader index, which is Sensex, has actually given a 25% plus kind of a average drawdown, meaning from its top, it has fallen by more than 25%. Does the same thing happen in US? The answer is yes. They also face similar such drawdown to the tune of 25%, but it happens once in every approximately 7 years. Now, if somebody is investing money into our fund or through any other mutual fund, if they see this kind of a drawdown, they are not happy about it. And that is where they start going back to the fixed deposits or the bank deposits. And that is why the growth in the mutual fund AUM is little lower. When we understand even further the hybrid category in the mutual fund segment, the mutual fund industry actually tried to solve this problem over a period of time. And that's why we have seen a lion's share of growth in the mutual fund industry in the past decade. But if you still go and talk to the investor as on today, they are still very apprehensive of putting their money in a equity, which is the first thought process that they should have. But that is not the case as on today. The hybrid model that the mutual fund industry follows today is actually a 60-40 model where 60% goes to equity and 40% goes to the debt. And that is what we call so far as a very, very productive model or a protective model. But the very aggressive hybrid model as on today, which is approximately having a 65% exposure towards equity and a 35% exposure towards debt, provides you with the equity taxation. Because we want to be called as a equity product, we therefore go to a 65% equity and a 35% debt model. Now, this is what this particular model does. But however, we all know about it, that the mutual fund category could not solve a fundamental problem. What is that fundamental problem as on today is what I'm going to talk to you about. So let's say if we have a 60% exposure to the equities and the entire market itself falls by 50-60%, which happens once in every decade in India, then there is an approximately 36% drawdown in the total AUM of the particular investor. Now, this is what he doesn't want. So if I am out of my 100 rupees, 60 rupees is still into equity and the entire market is falling by 50-60%, I will see a straight knock of 40% to my principal amount. And that is what the core problem is. That is what the fundamental problem is, because of which we are not able to get a lion's share of the savings. Now, if you see this particular category on a 1 year rolling basis, since more than 20 years, there are pockets in which it has fallen by even 20%, 30%. And there were times that this particular category has even shown a drawdown of over 50%. Now, this to us is the biggest challenge that we need to service and that we need to think about, and we need to find solutions to this particular core problem. So the core problem, now we need to first understand why there was a 50% kind of a drawdown, is because the 5-year average, if you see this particular chart, the 5-year category average equity exposure to this particular hybrid category was constant between 50-60% for most of them. So if my equity exposure is going to be constant, whether the market is going up, whether the market is coming down, so in a bad time, I am exposed to the correction that this equity model will bring in when there is a deep correction in the overall broader indexes that we all have seen over the years. Now, this is the core problem. And because of this problem, the only thing that actually the investors want from this particular category is not been serviced upon. The most important thing that people want from this category is a steady state return, which we call as FD plus return. The second thing that they wanted was the protection of their capital by way of lower drawdowns. That is the risk that they wanted to manage. And very important, the third part of return on capital in a bad time, like a COVID time, when everything was falling apart, they wanted their money back, but they could not withdraw that money because of the higher drawdowns. So they wanted a return of capital in a bad time or in the times when they need it the most. So in the hybrid category, traditionally savings is what they look out for. But if we can design a product where we can give little higher than the savings rate, and if we are able to protect the drawdown, this is exactly what they want from this particular category. And that is where the Samco's dynamic asset allocation funds are going to be recommended from here on. So what really happens is that we need to first understand that when a market falls by 10% from its top, it is still called a drawdown. When it falls by 20% from its top, it is called a correction of the market. But anything below 20% or higher upwards of 20%, it is called a bear market. Now, for us to protect the drawdown of a particular client, we need to make sure that we stay away from the markets when it is showing you a signal of a bear market. So it looks as simple as it can be, but it is difficult to implement. And that is where the fund management skills comes into the picture. We need to make sure that the discipline is being shown when we see a bigger than 20% correction in the market, and when the market actually falls into the bear category. So most of the model is actually going to show you a value model or a growth model will tell you whenever market corrects, it is even more attractive to go out and buy it. But when you start, catching the falling knife, we are bound to get hurt and we are bound to see the color of red. And that is what this particular category does not want to see. And that is what our solution will be for this particular category. Now, whenever you see a bigger time frame, this category on an average has even seen a 25, 30, 40, and even a to the tune of 55% drawdown over the years, it is because they have a steady state equity exposure of 50 to 60%, whether the markets are good or whether the markets are bad. So what we are going to do is at Samco Mutual Fund, we are going to attempt to solve this particular unique problem where an investor wants to stay in equity so that he can enjoy the benefits of an equity kind of a return. But in a bear market, he does not want to in equity so that he does not face the drawdown of an equity market. So it's like a magic wand that he wants, that in a good time he wants to own it, but in a bad times he does not want to own it. And how do we solve this particular thing? To explain this even further, I will like to hand it over to Umesh Kumar Mehta, who is the CEO and the lead fund manager for this particular strategy. Over to you, Umesh.
Thank you and a very warm welcome to each one of you. So before I deep dive into it, may I ask Chirag Joshi to play that film that tries to communicate what we are trying to do? Chirag, if you can just please.
Yes, Umesh. Give me a minute. I'll just play the film.
जब आप लंबे सफर पे निकले
One. Give me a minute. I'll just.
When you're on a long journey with a fast car and clear roads, it's great fun. But then you encounter an obstacle that makes you anxious. How would it feel if you could quickly cross that obstacle? And continue on your journey. Such transformations are tough in real life, but possible in your investments. Introducing Samco Dynamic Asset Allocation Fund. During momentum, it's an equity mode. And whenever the risk increases, it transforms into debt mode so that you can achieve your goals without any worry. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
So repeating what, to set the context, what Viraj has said, that there are these two unique problems that this hybrid as a category that we are witnessing. Number one is drawdowns. So drawdowns at times are mimicking market drawdowns, so which investors don't want. And so that's point number one. And second is the equity allocation is static. So it ranges from, as Viraj had shown, that from anywhere from 40 to 60%. But as a hybrid category, there is mandate that equity assets can move from 0 to 100 in that, for that matter, aggressive hybrid, or for that matter, DEF category. So, but the category average that Viraj had shown, it encompasses every fund. And therefore, the equity allocation ranges from 50-60%. And that's the root cause. The first problem is because equity allocation is almost static, when markets fall, that equity allocation also falls, and that causes drawdown. What's the solution? Solution that we at Samco we are bringing is, when markets are falling, it's time to get out 100% from equity and get into debt. That is how we will be able to protect the downside. And similarly, on the upside, when markets are trending, get aggressively into equity, and that's how we will be able to deliver return. So if I may, yeah, I'll share the slides so that I am not able to, yeah, if you can, Chirag, disable, and I can just
Yes,
start
Umesh.
sharing my slides. Thanks a lot. So this is how we as Samco, we are trying to solve this problem through our dynamic asset allocation fund. So during momentum or uptrending, we will predominantly be in equity over here, and then having substantial equity exposure during trending markets is going to deliver that capital appreciation, the high returns. And when there is escalation of risk, and when markets are dicey, when market changes trend, get into debt arbitrage mode. And this is how, when we take off the risk, when we take off the money from risky assets to debt, that is how we will be able to protect the downside and deliver what investors want, lower drawdowns during bad times, and at the same time remaining aggressively in equities deliver that kind of high inflation adjusted returns. So basically what Samco Dynamic Asset Allocation Fund does is the scheme is designed to real time dynamically transform depending on the market conditions, debt or equity, using our proprietary transformer model, which I will explain in a while. And this principle, trend is your friend. Sometimes there is no point getting into equity. This is what is this is the basis of the Samco's dynamic asset allocation fund strategy. So now let's deep dive further into what we are trying to do. So here, when markets are uptrending, the model works from 0 to 100% equity. This is how dynamically, when during uptrends, having aggressive equity exposures will deliver that capital appreciation. And when markets are falling, get from 100% equity to 100% debt. And this is how we will be able to protect the downside. So this 0 to 100, 0 to 100 cycle, this is what when we do, and especially in dynamic asset allocation fund Samcos, we will be able to protect the downside and deliver that high upside up potential which investors want. So all those facts, figures, number, I will cover that in a while. But broadly, from illustration purposes, this is how Samco's dynamic asset allocation will function. So now let's further understand how we will be able to do. So we will be able to do using our transformer model. So first, let us understand T, which is the main trends in equity market. So here, this is strategically an important factor which decides whether to remain in equity or to remain in debt or get into arbitrage or take off the risk. So this primary trends in market, the T is most important part of our broad transformer model. The rest 10 factors from R to R, I will discuss all these factors a little later, but this R to R factors allows us to adjust into the primary the equity allocation when markets are at extreme. So for assuming when markets are in bear mode, at times when markets reach extreme, markets are also going to turn and markets are going to move up. So that's the time when our R2R or tactical constituents will allow us to enter into equity at or near the bottom, and that is how we will be able to. So now let me show you all those with the help of examples. So basically what transformer model does is it has two I. Number one, strategic asset allocation. If the primary trend is up, remain aggressively invested in equities. And tactical allocation, adjusting the strategic allocation. If markets have reached an extreme, then our mean reverting indicators, those R2R models, R2R factors will allow us to take the reverse position. In bear market, once the market reaches an peak, we will be able to get into equity. And similarly, during market tops, once market reaches extreme, there is no point then getting into equity. When the trend turns or when markets show signs of risk, that's the time we will get out and add into debt mode. So now let's deep dive into transformer model, the equity part, the trend model. So this is the primary, the T, the primary trend that I was talking about. So how we will be able to do it? So we will identify the primary trend. How we will do? So now let me give you the maths behind this primary trend. We will use slope analysis, slope and angle. If the price slope is positive, that means the trend is up. And when the angles are significantly higher, the trend is the uptrend is established. Then what we will do is we will use regression models. We will regress the underlying trend. The underlying trend will have a volatility so that we know that this is an implicit volatility of the trend, and therefore stay away till the time significantly volatility increases beyond statistical significant number. That's the time when our model will identify that the trend has bent and get out from equities if it's a bull market. Same on the downside. And third, we are using time series and cross sectional momentum indicators to identify the speed of the market. So basically, if the slope is positive, angles are significant, the trend is up. uptrend is established, we will regress those the trend underlying trend with statistically significant number to know when the trend bends, and use time series and cross-sectional indicators to identify the speed. So it's simplistically, visually, let me explain this, what this transformer model is trying to do. So here, this is a phase, accumulation phase. This is where we would like to get aggressively into equities, ride this uptrend, and when there is distribution, get out from the market over here, get into that arbitrage mode. Therefore, we protect the downside. So this is how we want to do, and this is also the 4 phases of market. So now let me explain in a simple layman terms, how this transformer model will actually work. So during accumulation phase, when the slope of the market, when prices are above 150 or 200 a moving average, the slope of the moving average is flat. There are uptick, there are during up days, volumes are high. And when markets are correcting, volumes are low. That means this is an accumulation phase. Second, now comes the acceleration, or when the angle or the slope rises. So here the slope turns upwards, the prices are moving higher, volumes are also spiking during up days, and when markets are correcting, the volumes are low. This is how we identify the uptrend. Then comes the distribution phase. Here the prices move beyond certain moving averages, the slope of moving averages flatten, prices start falling, volumes start falling during down days. This is where we identify distribution is happening. And when downtrend begins, we know when the slope of the moving averages turns negative, volumes are high, markets are hitting lower levels, volumes are increasing on downfall. So this is how broadly 4 phases of the market operate in general, and our transformer model will try and accumulate during the accumulation phase, and then get out from equity and enter into debt after in between this board in this distribution and before the downtrend. So this is how our transformer model will work on the equity side. Again, to give a simple narrative so that common people can understand, this is what for from illustration purposes, when markets are moving higher highs. So if you see over here, after this fall, this correction was higher than this, and therefore similarly this series of higher tops, higher bottom, this was a confirmation to enter into equity aggressively. And over here this trend was continuing, and here when the trend falters or when the lower lows were hit, it is time to get out from equity, because the underlying bias or the underlying trend has changed. And this is how, when we get out from 100% from equity and enter into debt, that is how we will be able to manage this dynamically. We will manage this dynamic asset allocation fund. So important principles of trend following. Number one, bhav bhagwan hai. Trend is your friend till it bends. It's never about, the strategy is not about catching the tops and bottoms, and strength and health of each trend is different. And that is how mathematically we are capturing through slopes and angles, etc. So this is how our T, the main important strategic factor that allows us to get into equity or into debt arbitrage mode, is trade T, and this is what it is, principally following the trend following model. So now let me come to other R to R factors which I was referring. So now let me give you 2 examples out of that, the breadth and the 52 week lows. So basically what this R to R, the other R factor, does is it adjusts the strategic asset allocation. So basis the market's extreme movements. So now let me explain. During COVID 2020, 96% of the stocks were below their 40-week average. Only 4% of the stock were above 40-week average. That means this is an extreme. And when our system identifies extreme, that's the time to get into equity, because a market is a mean reverting animal. And when the extreme happens, the other way, just like दिन के बाद रात आती है और रात के बाद दिन आता है. So this is how this model identifies that peak has been reached in terms of pessimism or in terms of optimism, and therefore it will adjust the equity allocation. Second, number of stocks making 52-week low. So आप देखिए मार्च, दिस इज द ग्लोबल फाइनेंशियल क्राइसिस पीरियड, जब मार्केट गिर रहा था इधर इन 2008, so stocks making 52-week low were around 80%. And then again in March 2009, stocks making 52-week low were only 30%, meaning the broader market is unwilling to fall. And that is how we identify that peak in the market, the peak pessimism has reached, and now market is about to turn. So here, then get into aggressively equity mode over here. And somewhere here, the risk of trade took our transformer model out from equity, and here we were able to enter. So this is how we will protect the downside and participate when the markets are in bull market. So once the transformer model signals buy, then what to buy? This is what I will pass on to Paras Matalia, who will also give an idea once in equity mode how we will manage our fund. So over to Paras.
Thank you, sir, and thank you everyone for giving us time today. So, as he beautifully explained, that the transformer model will help us determine what should be the equity exposure, what should be the debt exposure. So, whenever we are managing the equity exposure will be managed using the momentum selection effect. And you can clearly see that momentum selection effect has historically been a very, very, very good source of alpha. You can see that compared to Nifty 50, which is the which is the top 50 companies of the country, you can see almost 9.5-10% alpha is generated by a momentum index called Midcap 150 Momentum 50. And Nifty 200 Momentum 30 has also been able to generate an alpha of almost 6.5% of CAGR from 1st April 2005. So clearly, the momentum selection effect is far, far superior. And we have been, a pioneer in this field by becoming the first mutual fund house in the country to launch an actively managed momentum scheme, that is Samco Active Momentum Fund. So whenever we are in the equity mode, we'll manage this equity portion as a combination of small cap, mid cap, large cap, where we'll try to follow a multi-cap model where we'll try to keep large caps at about 50%, mid caps at about 25%, and small cap at about 25%. And the total number of stocks would be around 90 to 100. So this is how we are going to manage the equity portion of the transformer model whenever we are in equity. For the debt part, please let me introduce to you Mr. Abhirup Mukherjee, who will explain to you how we'll manage the debt part of the fund.
Thank you, Paras. Just give me a second. Can you see the screen? Paras, is it visible?
Not yet. Not yet.
Abhirup, do you want me to share my screen on a slide?
Yes,
Yeah,
please.
please give me a moment. I'll do that.
So typically, as Viraj, Umesh bhai have already explained that once the trend changes from equity to non-equity zone, then we get into the portfolio composition of debt and arbitrage. So in debt, typically we would have typically two scenarios: one, a falling interest rate scenario, and a rising interest rate scenario. can we go to the next slide, please? We'll come back. Yeah. So in a falling interest rate scenario, is a time when you need to get into a duration. So we out of this extensive research that we've carried on, we've found out the sweet spot to be somewhere in the medium range of 3 to 4.5 years, where it's neither too low nor too high, so that when we are trying to protect the draw down the investment portfolio is not subject to too much of an interest rate shock also. At the same time, we should not also miss out the rally that might generate due to fall in the interest rates. Similarly, when the interest rate scenario, it's upward sloping, that is when the interest rates in the markets are moving up, we would typically maintain a portfolio duration which will be on the lowest possible end of the spectrum, which will be between 0.5 to 1 years. Now, the selection of the securities will determine will give cognizance to the market conditions, our internal research, and also we will use our internal proprietary model which we have developed called EDMO. Yeah, so the basically EDMO is equity debt mispriced opportunities model, which basically suggests that if we are okay buying a stock of a company, that means we have well researched the stock. We know that the financials of the companies are strong. That is why we are investing into that company, and hence there is no problem whatsoever. There should be no problem whatsoever why we should not invest into their debt. And typically, this model will help us identify such opportunities that might be mispriced compared to their peer sets, that is similar rated companies in the same category. Let me give you an example. 2 months back, there was an issue by Shriram Transport Finance Company, which is a CRISIL AA plus rated company. It came out with a 3 years maturity paper at 9% yield. At the same time, Muthoot Finance, which is the gold loan company, also rated CRISIL AA plus, was being offered in that 3 year maturity profile at 8.60%. So typically, that 40 basis points that I'm gaining is the kind of mispriced opportunity that this model will help us find, and in turn this will help us generate a better yield for the portfolio. It basically will help in enhancing the superior returns of the portfolio. Can we go to the next slide, please? Yeah. So typically, the debt investments will be made across the spectrum. That is from corporate bonds to the lowest maturity papers like CDCPs and treasury bills. Of course, it's a transformer portfolio, so it needs to transform itself as quickly as possible. So when the indication has been given, we would not be wasting much time. So probably within a space of 3 to 4 days, this portfolio will transform from debt to equity and vice versa whenever the need be so. So I need to have such securities in the portfolio which are of very high credit quality and at the same time provide me the highest liquidity in debt. So it will be a mix of AAA, AA plus and AA papers which have that pedigree, that vintage quality of business, that liquidity, and the marquee quality that we are talking about. And the attractive valuation and misprice opportunity would be sought using the EDMO model, and of course our internal extensive research on the market situation will determine the composition of the debt portfolio. I think I'll hand over now to Mr. Umesh Mehta to take it forward.
Yeah. Allow me to share screen, Chirag. Yeah. So now, coming to the power of transformer model. भाई बनेगा कितना, रिजल्ट कितना बनेगा, कितना रिटर्न आएगा, क्या ड्रॉडाउन है, this is what everyone is now waiting for. So now let's see that. 1 year rolling return, the blue line is Samco def, blue line is, and the red is the benchmark. See the mountains of the blue mountain that you see over here is because of what Paras said, that because of our momentum effect, our momentum selection effect. So the in bull market जो स्टॉक सबसे ज्यादा अच्छे चल रहे हैं उसी में इन्वेस्ट करो अपना इन्वेस्टर का पैसा. दैट इज व्हाई we were able to get this kind of mountain type return or blue. So now let's look at the 3-year rolling return period. So again, the blue line is the Samco DEF model and the red line is the benchmark return. This is how Samco's DEF model return will perform because we are getting into momentum stocks, and further after momentum stock, the power of mid cap and small cap. So this is how we have designed our strategy, not only to deliver return on the upside, but also protect the downside. And the next slide is the most important slide, how it will work in how drawdowns will happen. So the red is the market drawdown, and the blue line that you see is the Samco devs transformer models drawdown. अगर मार्केट 60% गिरा अपना मॉडल 12-15% गिरेगा, मार्केट 30% गिरा अपना मॉडल 12-15% गिरेगा. Our drawdowns are protected, and this can only happen because we run a market following model. जैसे ही मार्केट में चिंगारी लगी आप मार्केट से भाग जाओ, otherwise that चिंगारी will can turn into a bigger fire. और मार्केट में हमें ये समझाया गया है कि मार्केट the moment market starts falling, get into the market, but that is how major drawdowns happen. Every drawdown happens during market. When markets are falling, drawdowns happen and we start buying more and more. Assuming 100 years ago US market, अगर हमने वही strategy use कर दे तो 90% market गिर गया. अब जैसे market नीचे जाता है लेते जाओ. Sir, drawdown अगर आपको बचाना है तो उसका एक ही तरीका है, the moment there is change in bias, get out from the market, get into a risk off mode or get into debt arbitrage. Then and only then we will be able to protect a drawdown. This is what the need of the investor is. So when Viraj has initially identified the key highlight, what investors want, the 3R, return, risk and return of capital. जब उसे पैसा चाहिए तब कब ले पाएगा वो? When there is a lower drawdown, and then only we will be able to get lot of money from fixed deposits. आज hybrid fund में खाली 6 लाख करोड़ है, 200 लाख करोड़ is the bank deposit, and hybrid fund is around 6. So this is where there is a major requirement of investors that please protect us the drawdown, and only market following model. See, there are so many funds out there, so many strategies, all are good. But today, Samco's DEF model is uniquely placed in this industry. We are the only fund who has the market following model, which says that when markets turn, get out from equity 100% and get into debt. And when markets turn from downside, get into equity aggressively. So now so next slide will show the kind of return that this strategy will generate. This is the kind of return. DEF model, 20% since 2005, and Nifty on a like-to-like basis is 14%. See the huge difference. And the best part is the standard deviation. Standard deviation of DEF model is 12.74% compared to Nifty is 21%. This is how what the commitment on the DEF side is, that we need to protect the downside. Okay, this is what the numbers speak aloud, standard deviation of 12%. And this can only be possible, my friend, because of when we get out from the market aggressively and move from 0 to 100 debt, is we will be able to protect the downside. And that is how those last 15 years of data, my previous slide, we were able to protect the downside. And ultimately, so what are the sources of alpha? How we were able to do this 20%? Basically, if you think logically, this 20% is easily achievable. So drivers of return, number one, zero equity exposure during bear markets. This saves a lot of money. And then when bull markets come, you aggressively invest 100%. This gives the magic of return. And then alpha comes from mid and small cap exposure, which Paras had highlighted, that around 25% small and 25% mid cap. And then comes the major kicker of momentum selection effect, wherein you buy the best lot from the large caps, from the mid caps, from the small caps, the stocks that are running faster than the market. And when you create such portfolio, we will be able to generate that kind of return. So now let me quickly explain the effects of the four principles. Zero equity in bear market. Here, when when markets have reached peak, it's time to take off money, get aggressively into debt, and get out from equity. Again, over here, this 2009, I had also explained in my previous slide in one of the examples, net 52-week low. Over here, our R to R, our model will permit us to get into equities over here, then again buy, sell. And this is how during COVID times we were able to protect the drawdown, because we were able to exit early. See, in hindsight, it's people can say that, oh wow, market had fallen, but no one knows on a real time basis how deeper markets can fall. And by buying more when markets are falling is a short way of giving drawdowns. And therefore, our transformer model does the exact opposite what others are doing. It follows the market. If markets are rising, get into equities 100%. If markets are falling, get out of equities and protect the downside. This is how the transformer model works. Again, the magic of equity: when markets are in bull market, invest 100% equity. So from illustration purposes, 50% portfolio delivers 72%, and 100% equity invested portfolio delivers 182% return. देखिए, जब बुल मार्केट आएगा ना, तो अपना इन्वेस्टर बोलेगा मेरे को हाइब्रिड फंड में अच्छा रिटर्न चाहिए, बिकॉज अगर वी इफ वी स्टार्ट कैपिंग, इफ वी स्टार्ट सेलिंग एंड इफ वी हैव 40-60 एक्सपोजर, उसको बुल मार्केट में रिटर्न भी नहीं दिखेगा. So this is what, if there is bull market, let's give him the best return on his every penny that our investor invests. Again, alpha from mid and small cap. I don't have to deep dive further. You all know what the large caps can deliver, what the mid caps can deliver, what the small caps can deliver. So we have 25% on small cap and mid cap, and 50% large cap. And here comes the momentum effect. You know that historically, momentum has delivered far better returns than the Nifty 50, and this is how the alpha from momentum comes. So buying the best 50 stocks from top 100 stocks, buying the best 25 stocks from the top mid cap stocks, buying the best 20% stocks from the small cap stocks. I think this is how, when we create this portfolio, it takes the return. So broadly, let me summarize before I pass on to Viraj. Investment strategy of Samco Dynamic Asset Allocation Fund. So basically, this will determine equity allocation based on primary trend. भाव भगवान है, अगर मार्केट में तेजी है तो दबा के सब माल लो, और अगर ट्रेंड चेंजेस when markets are falling, as I told you, our R to R indicators will identify that markets are turning, we will get out from equity, or on the downside get into equity. So net 0 to 100% exposure during bull phase, and during risk off period, or during bear phase, get into debt or arbitrage mode, that also 100%. And while in bull market or equities, or while in equity mode, through momentum strategies, create that kind of extra alpha for our investors. And while in debt mode, using the proprietary EDMO model, my mistake, not proprietary, the EDMO model basically means that अगर हमको shares का, अगर हम shares में invest कर सकते हैं, तो उसका हम debt भी ले सकते हैं. So I think that is what EDMO means, and this is how we will protect the downside during the risk off period. So yeah, broadly, this is where Samco's dynamic asset allocation fund strategy belongs to. So now over to Viraj. Thanks.
Thank you, Umesh. And here comes the most interesting part. As a CEO of Samco Mutual Fund, I see this business into three P's: the product, pricing, and our partnership, the partnership between the manufacturer and the distributor. I'm going to talk to you about these three aspects. So as far as the NFO goes, this particular product will be up for the NFO dates will be from 7 to 21st of December. It is going to be very, very interesting, guys. Please make sure that I have your complete attention for the next 5 minutes. So as far as the NFO date goes, it is going to be between 7 to 21st of December. As I told you, it is about the 3 P's. The 3 P's. Am I now clear? So as I told you, it is about the 3 P's. The first P is the product. As we have always promised you, that we will be bringing the differentiated strategy, and this is yet another effort from our team to bring you something really, really different and first of its kind transformer model. Now, as far as the scheme features goes, the benchmark for this particular scheme is going to be the Nifty hybrid composite and debt 50-50. The minimum application size is going to be 5,000 rupees. The minimum SIP amount should be minimum 500. You will have both the plans, the regular and the direct plan. There will be a lot of options available for you. The IDCW reinvestment, IDCW payout, and also the transfer option is also available. Now, as far as the exit load goes, there will be zero exit load for the first 25% units. Yes, you heard me correct. Nil, zero exit load for the first 25% unit, and for the balance 75% unit, there is only going to be a 1 year exit load of 1%. Now, as far as my team goes, you have heard all of them. Umesh Kumar Mehta, the CIO and the lead fund manager for this particular scheme. He will be accompanied by Paras and Dhaval. Paras is going to be the equity fund manager for Indian stocks, and Dhaval is going to be for the foreign stocks. We have kept this option also available in this particular scheme, but right now we are going to focus only on the Indian stocks. On the debt side of it, with a vast experience, Abhiruk Mukherjee have joined our ranks, and you have heard him also. Now, as far as the riskometer goes for this fund, it is always going to be the high risk as far as the riskometer goes. Again, I started with a disclosure that we have going to use some stock specific example. This is just our view. This is neither a buy or sell recommendation, and the standard mutual fund disclosure applies to us. Now, as far as our partnership goes, how do we take this product and how do we disseminate this product to our clients? This is a simple 5-step explanation that I'm going to give you, which you can actually give it to your clients in 2 to 5 minutes. Point number 1, it is going to be a momentum trend following system. Meaning, in a good market, it is going to stay into equities 100% and try to create that alpha. The second most important thing is to protect the downside, protect the drawdown of it. In a correcting market, where I first told you that about 20% is a bear market, it is going to get out of equity and look to invest into debt, and also by way of arbitrage, we are going to protect the equity taxation part of it. So I see many of you asking this particular question. This is going to be a product which will attract equity taxation, because we are going to use arbitrage as an option along with debt to make sure that we are minimum 65% invested through the gross investment route, but through the net investment route, the equity exposure will be far, far lower. It is going to be a real-time asset allocation model, which you have already seen in my previous active momentum fund. We are somebody who will shift from equity to debt and debt to equity on a real-time basis as far as the indicator tells us which side of the market we need to be, whether we want to be in equity or whether we want to be in debt. So it's going to be a 3-layered approach. First, because of the transformer trend model, we will take a market call. Because of the stock specific momentum calls, we will get an entry and exit signal on the stocks. But very important, the moment we go on the other side of these two models, we have an absolute stop loss also in place to protect the downside of our clients. So it's a very, very important and a simple 5-step process that we are going to follow. Be in equity in a good market, come out of equity in a bad market, protect the taxation through debt and arbitrage. We also are going to do it on a real-time basis through our transformer model. And we also have a stop loss in place to protect the downside. These are the 5 things. This is what I mean by the second P of our partnership. When we build something, We need your support to take it to your clients so that they can also enjoy the benefit of this particular model. Over to you, Chirag, and please help our partners understand how we can do the entire co-branding activity together and take this product to our clients as we want it to be. Thank you very much, guys.
Thank you, Viraj, Umesh, Paras, and Abhirup. I'm really personally a fan of you guys presenting in such a easy way, a product like this for our partners to understand. But to market a product like this, me and my team, we've worked to help all our partners present on the call with a lot of co-branded materials, a lot of ATL support. You will see our TV ads on a lot of TV channels very soon. Some of the TV channels have already started showing it. So all this support is for our partners. As a part of the co-branded marketing effort, co-branded materials effort, we've already uploaded one pagers, which are flyers, which can be printed and also shared on WhatsApp in different languages. These flyers are available in 6 different languages: English, Hindi, Tamil, Gujarati, Kannada, and Bengali. If there is any other language that you might need, I would urge you to contact your relationship manager and we'll get it done in 2 or 3 working days. But this shall help you push the product to your clients. And this one pager summarizes the whole strategy that Umesh, Viraj, Abhirup, and Paras have taken us through beautifully today. Apart from one pager, there are a lot of infographics that we'll keep uploading on the Samco Mutual Fund Partner portal. I will soon cover how you can download this co-branded material in the coming up slides. There's also 5 reasons why you should invest in Samco Dynamic Asset Allocation Fund and a couple of other WhatsApp shareable infographics that will help you, put this up as your status or share it with your clients over WhatsApp or an email. The ad that I just demonstrated, while Umesh was presenting, is also available to you in a co-branded material. Has a co-branded with your logo and your contact number. I will quickly show a sample and then I will demonstrate how you can download the same ad, on your computer and share it with your clients.
जब आप लंबे सफर पे निकले, तेज गाड़ी, क्लियर रास्ते, मजा अलग है। पर तभी आ जाए ऐसी अड़चन जो आपको कर दे बेचैन। कैसा लगेगा अगर आप उस अड़चन को एक चुटकी में पार कर दें? और वापस अपने सफर पर निकल पड़े। ऐसा ट्रांसफॉर्मेशन रियल लाइफ में मुश्किल है, पर आपकी इन्वेस्टमेंट्स में हो सकता है। पेश है सैमको डायनामिक एसेट एलोकेशन फंड। मोमेंटम में ये रहे इक्विटी मोड में, और जब भी रिस्क दिखे ये ट्रांसफॉर्म हो जाए डेट मोड में, ताकि आप अपनी मंजिल तक बेफिक्र पहुंच सकें। म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
As we saw in this video that the partner's name, the partner's contact number, and everything is displayed co-branded. This is the version that you can share with your clients over WhatsApp and also put it up on your social media. Now, the next question is that how do you download this co-branded materials, the infographics, the one-pagers, and the TV commercials in different languages? Right now, the Hindi TV commercial is live on the partner portal. By tomorrow morning, an English version of it will be live. And soon, this will be followed by other languages like Tamil, Telugu, and Bengali. Once you download to your Samco Mutual Fund Partner portal, you log in with your ARN number. You go and you click on the top round menu icon, which is highlighted here on the top left. Once you click on it, you will see the third option, which is called co-branded materials. You click on it and you will see 2 sections. One is co-branded video and one is co-branded material. Right now, I've highlighted the Samco Dynamic Asset Allocation Fund. All you need to do is just choose a language and hit the download button. And the ad that I presented to you right now with your name, your contact number, your email ID, and your logo will automatically be generated and shared with you. On the top right, you see the settings button. This is the button where you can use to change your mobile number and email ID, just in case if you have your Salesforce and you need to use them, to share it with your Salesforce with your respective clients. Similarly, there are a lot of co-branded collaterals that are there. 5 reasons why you should invest in Samco Dynamic Asset Allocation Fund, and the one pages in different languages. So in all possible ways, me and my team, it's a clear mandate to us that we need to go all guns blazing to support our partners to market this scheme to their clients. And with this, I would request Jimmy sir to kind of give us a closing remarks before we take up the Q&A. There are a lot of Q&As flowing in. So after this closing remarks, we'll handle all the questions.
Sure. Thank you so much, everyone, for a very patient hearing. What I would like to do is just simply, summarize the fact that, we've built a very differentiated product in the hybrid dynamic asset stroke balanced advantage fund category, where we are trying to reduce the drawdown to try and improve the return that an investor can generate, and at the same time while maintaining an equity taxation structure using a mix of debt and arbitrage. I think, and this is probably, as Viraj highlighted, as Umesh highlighted, this is probably the only market momentum trend following model which has the capability of going entirely from 0% equity to 100% equity, as well as going back from 100% equity to 0% net equity exposure using debt and arbitrage. So I think there is a unique opportunity. Plus, we've we've sort of facilitated a lot of material to partners to be able to communicate this to customers at large. We have a large scale advertising campaign that's going on. In fact, you will see us in the next 20 days. There is a blitzkrieg campaign that will help in generate investor demand and queries as well, and help assist partners to communicate and market this product to their end customers. And obviously, my humble request to all of you is that you all have been supportive of us. You all have supported us for the past year and a half. We request your support once again in big numbers. Not only participate, but also tell your friends, family, and your other distributor friends to participate, and allow us. We are here to create a differentiated asset management company for investors, and we want to create a lot of wealth for investors over the next few years, and we will continue to expect your support. So thank you so much once again, and Chirag, you can now take up the Q&A.
Thank you, Jimmy sir. Yes, we have a lot of questions flowing in. I will structure them and I'll direct it to the respective concerned person. Before we start, Umesh ji, if you could, take this question up on how will we understand if the equity time is good or bad, or trend is changing. I know you covered this in the presentation with slope analysis and a bit of explanation of market cycles, but quickly in 30 seconds, if you could give us an example and explain how will we turn into equity, understanding it's a good time, and then vice versa.
Correct. So if it's, let me explain on myself. So I can run at an average speed of 13 km per hour. If my speed reduces from 13 km to 10 km per hour, meaning अब मैं थक चुका हूँ, my speed is falling, I can come back to zero. So there is no point riding on me, because statistically my speed has reduced beyond a certain point. So this is how market, as an underlying trend, there is an implicit volatility. We account for that using regression model. But if market falls beyond that level, or market falls beyond a statistically significant number, that's the time we get out if it's a bull market. And on the other side, if it's bear market, we get in. This is how we will identify, the primary trend and the corresponding entry and exits for the primary market.
Umesh, just a follow-up question by Mr. Kamal, that if we are not investing in equities in downtrends, or when the markets are falling, will we miss out on stocks that are available at lower valuation, which is basically opposite to what our strategy is? But if you could quickly just follow up explanation with this understanding.
See, when markets are falling, 90% of the stocks will fall, and when markets are rising, 60% of the stock will rise. So this is how broadly landscape of 100 years of data is. Therefore, in bull market, equity market, we are investing in all those stocks that are moving, or the stocks that are in momentum. So we are in that right side of the market in terms of stock. And when markets are falling, it is possible some of the stocks may be rising, but broadly 90% of the stocks are falling. There is no point getting on which stock will rise. So that's why it's a two-tier model. We look at the market, the primary trend. If the primary trend is down, get out from everything, and if it is up, get into the best of the stocks between large, mid, and small caps. So this is what strategy we are deploying.
I would like to add to this. So valuations can remain cheap for a very long period of time, and valuations can become even cheaper, when the things are going really bad. So you don't know where the bottom will be made, and that is why you want to enter equities when the markets have turned, and you have good chance that markets have turned.
Mhm. Thank you, Paras. I think this summarizes. But Umesh, again, a follow-up question. I'm just collating all the questions related to the equity part of the scheme. Will this scheme lead to a higher churn ratio, or and the second question to that is that what will we do in a flat market?
Correct. See, churn ratio will depend on if the markets are trending, there will be no churn, bare minimum. If markets are flat, but where? If during rising market, if the markets are flat,
Mhm.
still we will be in equity mode, and therefore that the sideways correction phase will not take us out. Only when markets fall, that's the time we get out from equity, and that's the time that creates a turnover. It is also possible during a year we might just once get out and get in on the market, and sometimes we could be wrong. Even a 0.5% cost sometimes once a year, if we just simply get in and get out depending on the signal, and then again market turns, still we are able to protect the downside. But more than that, I think that is what the returns are being generated. So आधा एक टका कभी लग भी गया because of whipsaw trade. Some of the questions that people have raised, that क्या होगा अगर मार्केट में पॉसिबल है नीचे आके वापस ऊपर गया. But still what we say, market we have identified statistically significant number. खाली 800,000 पॉइंट निफ्टी ऊपर नीचे होने से we will not get in and get out. So the moment trend changes, that's the time we will get out. But at further, sometimes we may get whipsaw trade, so we will take that. And because we never know if the market sell signal is there, and if we don't take that sell signal, that sell can really take the drawdown far deeper. We will take the, but if market changes, we will also transform real time basis. We will transform and we will get into equity mode. So sometimes, yeah, there will be certain whipsaw signal, but we will take. But the cost is still bare minimum 0.5% here and there. But when we compare to 20%, 15-year average return, I think sometimes leaving that 0.5% is still far better than compared to the other.
Thank you, Umesh. Viraj, if you could take this question up, I see a lot of comments in the chat that say that why not gold, why not invest, why not REITs. I think this is specific to the category. So if you could just quickly summarize, why debt and equity as an asset class.
When we speak about dynamic asset allocation, it is about equity and debt. When you are talking about many other asset classes like gold, it is meaning it's a multi-cap or a multi-asset allocation. Now, what do I mean by this is, for this particular category, you can only have equity and debt. For us to go into gold, we need to file under multi-asset allocation, which is not the offering as on today. We might work on it a little later.
Sure. And Umesh, a follow-up equity question by Mr. Deven Shah is that when you are invested like roughly 60% of your equity portion in large cap, why exit? Wouldn't you recommend to hold them for a long period of time and then stay invested in the equity portion in the large cap? Why exit?
See, the commitment or the communication that we have to our investors, and this is where the hybrid category that has been created. The principal aim is to draw down protection. So because we have to be true to what we are saying, and as part of strategy, when markets are falling, even large caps will fall. So that is the reason why we follow that two-tier model. That the primary trend is down, get out from equity, get into the old stocks that are in uptrend and are in momentum.
I'd like to add one more point to this particular question, Chirag. The primary aim of a fund management is to create wealth for the clients over a long period of time. There is an inherent thought that just because it's a large cap over a long period of time, it will make money for the investor. This fact is not true. There are a lot of large cap, I'm not naming anyone, but for the past 10 years, they have either not made money or actually have given a drawdown to the clients, even if you are holding it for the past 10 years. So the
Got it.
primary aim of the fund management team is to generate returns, is not just to buy stocks. So like in the game of cricket, if you are a batsman, your primary role is to score runs, just not to protect your wicket. So keeping this in mind, we are going to make sure that we buy the large caps or the mid caps of the world, which we believe can generate wealth for our clients more than the risk that is ready to pay for it.
Got it. Thank you, Viraj. Thank you, Meshi. Umesh ji, and maybe Paras can chip in. How quickly can you turn from debt and arbitrage to equity in real time scenario? Let's say there is a black swan event one day.
One day.
I think that answers the question where when we repeatedly say that it's real time and dynamic. So Moiji, the answer is one day. It'll take one day for us to shift the portfolio from equity to debt and arbitrage and vice versa. How Okay, now when you say that you will need one day to exit equity, Umesh, if you are invested in small and mid cap, will there be a whipsaw effect? Will there be impact cost? How will you manage that?
See, the mid and small cap, obviously when we are investing, in the momentum stocks. So momentum stocks have got high liquidity, high volumes that are being traded. And given the wide spread of stocks that we have, as Paras has highlighted, around 90-100 stocks, so we'll be easily able to execute our portfolio. The large caps can be done in just half an hour, 15 minutes. The mid cap can be done in half an hour, 1 hour. Small caps, certain stocks, and some of the stocks can take a little day or can go beyond one day, but largely entire portfolio can be liquidated. See, markets volumes are huge. There are 70-80,000 crores of daily cash volume, and managing 1,000-2,000 crore, assuming we get that much fund, is very possible.
Thank you, Umesh. Just scrolling to the questions. Okay. In the current market scenario, Umesh, what would be our debt equity ratio? If you could just give us some context on that.
So currently market is full equity mode. Uh, this is where our transformer model currently shows that slightly there could be slight adjustment on our R2R model, but largely it is equity mode.
Thank you, Nafkar Financial. I don't see, but he's appreciated our radical thought and how we put efforts to come up with differentiated products. For everyone who's requesting for the presentation, we've already circulated an abridged version of this presentation that you can share it with your clients, but we'll reinitiate the circulation via email. I would request the marketing team on the call to please make a note and circulate the presentation post this call. Umesh, a counter question that why are you choosing 50% large cap, which can probably reduce alpha in a bull run or when we are saying in equity mode? Why would you not, give greater exposure to small mid cap?
See, actually, it is a myth that large caps don't deliver that high return. So, out of top 100 large cap stocks, the current top 5 stocks have delivered around 40% return. Your NTPC is probably in the top 10 decile. NTPC has delivered 35-40% return. Your Larsen L&T has delivered that kind of return. So large caps have the potential, but it is only that you have to identify the correct way, how to identify that momentum and then ride those momentum till the time it lasts. I think that's a skill that probably I think Paras and our entire team has developed that, and to how to get into that momentum, identify those momentum and ride that momentum wave is the crux for generating alpha. And this is how we will be able to do. So large, mid, small, everywhere there are good stocks. There are stocks that can deliver return. So large cap also has the potential and they deliver return.
Thank you, Umesh.
Also,
Sorry,
the
yes, Paras.
combination of large cap, mid cap, small cap would result into lower volatility of the NAV. So that helps for a hybrid product.
Okay, thank you. Sanjay ji and a lot of other partners who are requesting, yes, we will be on NJ Prudent platform. I would also urge you to contact your relationship manager with these NDs and request them to enable you with our product on their platform. And I think that way you would be able to, invest in this platform. Co-branded banner, everyone present on the call, you would have to log in to your partner portal or request support from your relationship manager to get this downloaded. Umesh, one question. Since we are using momentum strategy also in the equity mode, will there be an overlap in the portfolio of active momentum fund and the dynamic asset allocation fund?
Possible, yeah. It is possible that some stocks can overlap.
Okay. Hmm. Yeah, a lot of people want to know why have we closed fresh subscription in active momentum fund, but we'll hold that question for the next webinar. I would honestly want to focus on the dynamic asset allocation fund. We've got a lot of interesting question on the scheme itself. Yes, Abhirup, if you could quickly, explain. There's one gentleman, Mr. Vinod Prajapati. He wants to quickly understand how will we how will we manage the debt portion.
So as I already explained on the presentation, so typically when the interest rate scenario is on a falling rate scenario, then we would go a slightly medium to high range. We've already found that sweet spot of 3 to 4.5 year kind of a duration, which we intend to maintain so that the portfolio is neither too short, neither way too long on the duration, and is protected against any undue investment interest rates shock. On the contrary, when we are in the rising interest rate scenario, is when we would typically maintain a very low duration of between 0.5 to 1 to protect the downside and any any excess leakage that might happen due to continuous rise in the interest rates.
Thank you, Birup. Exit load, Pankaj ji, 25% units, nil, 1% for 1 year on rest of the units. And on second year onwards, there is nil exit load. This is a suitable product if you recommend an SWP to your clients on the huge retirement corpus. And, if you can put it, and, generally I've heard a lot of distributors recommending a certain percentage of the corpus and SWP format. So this product is completely suitable for that. Okay. I'll give me a second. I'm just going through a lot of questions. I have like 100+ questions. Taxation and gold and other assets we've already covered. Brokerage structure, Viraj is already covered in the presentation. Yes, we'll share the presentation after this call. We'll try and take compliance approvals and also try and share the recording on our YouTube channel. Mr. Pradeep ji wants to know, Paras and Umesh, if you can take this up, why 90 to 100 stocks?
So I'll take that. Again, 90 to 100 stocks help us with reducing the volatility of the fund NAV, which is usually the expectation from this kind of hybrid category fund. Now, when you are well diversified across large cap, mid cap, and small cap in about 90 to 100 stocks, a big crash or something that goes wrong into the stocks is because they are of momentum, selected by momentum style. Your investment, your money is very well protected. That is the rationale behind why 90 to 100 stocks will be there in the portfolio.
Okay. Mr. Aditya Pallav wants to know that, how will we shift in one day when the AUM reaches 20,000 crore? First of all, I would like to thank you for showing that trust in us. I'm very confident we'll reach that number soon. But Umesh, if you'd want to cover, and how will we be so agile even at a 20,000 crore AUM?
Yeah. So assuming we reach 20,000 crore, and by the time markets, India will reach from fourth to third, and the journey will remain higher. So we will incline ourselves to a little bit of large caps more, because because where liquidity is there, we want to get in and get out. So we will ensure that our portfolio is liquid enough. At least in a day or two, we should be able to move in and move out, and we will therefore design our portfolio basis that, given that we should be able to get in and get out. So even a 20,000 crore fund should not create a problem. If not one day, in 2 days we will be able to do it, but we will be able to do it.
Yes. To the whole Samco MF team, a lot of distributors are appreciating the performance of active momentum and ELSS schemes. I thought I'll convey this to the whole team. Okay. Anitji wants to know if we can do a seminar for their doctors in the city. Definitely, I would urge you to contact your relationship manager, and we can definitely work something out and do a session for your clients as a part of our IAP program. Okay. So one last question, I think, before we conclude the meeting. Umesh, would you say that our dynamic asset allocation fund is slightly more aggressive versus other dynamic asset allocation fund in the category?
See, using the word aggressive is not the right word. Using the word apt, what investors want, and we have to deliver that and remain true to it. Just because we have that liberty that to move from 0 to 100, but if we don't use that, or if we just have a static, I think what we were surprised is the entire category, they had a static equity allocation, almost ranging from 50 to 60 or 70. But when markets are moving ups and down, it is a mandate that either we remain in equity or in debt. But ठीक है, वो रखा है steady state allocation. That is what we found out, that look, let's be true to what we are saying and what the category allows us, and we will do that. So we are so I think that's a short answer. What we are saying, what regulation allows us, and that is what we are executing. Ultimately, for our investors, this is what we are doing.
Okay.
The bigger point here, Chirag, let me just
Yeah,
conclude
yeah.
that the bigger point over here is the adaptability to the market condition. Guys, when somebody is working 9 to 9 and putting their heart and soul to earn that 15-20,000 rupees and putting it in an FD for their child's marriage or for their education or for their home loan repayment, and is trusting you and me and taking that money out and giving it to us, the first thing that he wants is an equity return, which is FD plus return, and the second thing he wants is the protection of that capital. Now, what do I mean by adaptability is, if it is in a good market condition, yes, we'll be at 100% equity. But if the market condition turns and we adapt to that particular market condition and try to protect their capital by going out of equity, does not mean we are aggressive. It only means we are doing what we are supposed to do with that kind of funds, which we and may have promised while they were investing with us. So adaptability is the name and not aggressive.
Thank you, Viraj. There's one question from Naukar Financial. They want to know, and Abhiru, probably you could chip in here, is that, when we talk about investing 100% in debt during, maybe anti-momentum period, and if there's an economic downturn, there could be major risk of default and, interest rate raise rise. If you could just throw a light that how will you manage this, or how will the debt and arbitrage portion manage this?
Okay,
So I
firstly,
will also chip in later. Yeah.
Yes.
sorry, Umesh bhai.
No, I will also chip in later. So
Yes,
because
yes. So, firstly, the portfolio will never be 100% debt. It will always be a combination of debt and equity arbitrage. Secondly, uh, while investing in debt, as I said, we would give the priority to credit quality and liquidity of the instrument that we are investing into. For the matter of fact, even if the economy goes towards downtrend, it's not that everybody or anybody will go into default, and we will do our credit evaluation before investing into a company. Even if we invest into a company through EDMO, which is that equity debt mispriced opportunity model, over there also, as Umesh Bhai and has said in the presentation, that bhav bhagwan hai. So basically, the pricing basically tells you, gives you a far more faster indication as to whether a company's financial health is deteriorating or not. So that these are like few of the instances that I'm telling you that will help us evaluate whether the company's credit health is good or not. Secondly, as I said, I mean, we have seen economic downturn cycles in the past. 5 years back, when the ILNFS and DHFL defaults happened, they were the two companies. Yes, ILNFS was a AAA company which defaulted overnight to D, but you don't, those are one or two such black swan events which happened. It does not encompass the entire market into itself. So typically, while investing, first and foremost, we will do a credit evaluation, and we will have a periodic checks in place in all the instruments that we are investing into. So this is a regulatory requirement as well. Plus, it's a practice that we are going to follow. So the credit health is always going to be on a constant monitoring basis. So that's how we will be able to ward off any such credit events, if at all it happens.
Yeah, thanks. So largely we all are equity guys, right? So Abhiru comes from the debt side, but our principal aim in DEF is to have optimum liquidity and duration. So largely हमारा purpose focus यही है. In order to protect the downside, we want to be as जितना short term paper होगा actually. And I was telling Abhiru that GSEC में अपन पैसा invest करते हैं, वहां पे risk भी नहीं और सॉवरेन का गारंटी है, अपना डाउन साइड भी प्रोटेक्ट होगा, 6.5% अपन को ब्याज भी मिलेगा. देयर इज नो पॉइंट गेटिंग इनटू ड्यूरेशंस एंड ऑल दोस थिंग्स. सो या Abhirup's point from understanding the debt market, it's right, but how we want to do it on Samco DEF is क्योंकि we want money so that अगर मार्केट में equity है, if risk on है, we want to get out and get into equity. पैसा equity से ज्यादा equity में बनेगा, but debt or arbitrage is only to protect the downside, and therefore our principal aim is, yeah, largely it would also be arbitrage, but the other part would be it would be extreme short term, or मतलब sovereign guarantee में पैसा रखेंगे so that we can quickly get out and get into equity. That would be a large focus rather than getting into certain durations and taking those bets. ब्याज डेट से ब्याज नहीं कमाना है, डेट से रिटर्न नहीं बनाना, वो तो खाली प्रोटेक्शन के लिए. सो वी वांट टू गेट एज मिनिमम एज वी वांट, but yeah, we will protect the downside and not get into the risk part of it.
Thank
So,
you, Abhiru.
this is a very interesting question. So I also want to add one more point. As Umesh Bhai said, we are primarily an equity guy. Now, when we are buying a particular debt of a particular company, it doesn't go bankrupt from a hero to a zero on day one. Okay, the stock price will be the best indicator to tell us what is happening wrong in the company. So let's say, for example, there is a company ABC for whose debt is giving us the EDMO model, as far as the Abhirup's explanation goes. But we will not wait for that company's price to go from 100 to 0 and we'll keep watching it. Okay, what does he mean by the equity debt mispricing model is, if the equity is at 100, but the debt is showing a pricing of 40, 50, that is the EDMO model. We are not buying the debt of the company which is already at 40 from 100. I think if this is clear to all of you, we are not trying to find a debt paper for whose equity is also under the depressed pricing. Okay, we are trying to find the debt paper of the companies whose equity is showing you the strength, but the debt is giving you the mispricing opportunity. And we are going to be a transformer model there also. If we find that we are on the wrong side of that particular paper, it doesn't take time for us to get out, because liquidity and quality was the highest priority before even investing into that paper.
Correct.
Yes. So Mr. Mehul wants to know that, will it be 0 to 100 equity directly? So I know, Umesh, in your presentation you covered it's not binary, either equity, either debt. But quickly in 30 seconds, if you could explain that, when we say 0 to 100 equity, 100 to 0 equity, how will the percentage be decided and how do we shuffle?
So as I told you, in a day or two, we will get the moment our trend indicator signals, and using our tactical indicators decide that this is what we need to get into equity mode. In a day or two, we will get into equity mode, buying 90, 100 stocks. And this is how, vice versa on the other side, this is how we will be able to do it. So it's a matter of 1-2 days. We will be either in or we are out from equity and get into the debt or arbitrage.
So I think to add to what he said, so trend model gives us a 0 to 100 equity or debt signal, but the adjusting factors that he explained, R to R, tactical factors, will help us to adjust the equity exposure either less than 100 or probably 20, 30, 40% also. So there would be very short periods of time when it will be say 20% or 30%. I hope I have cleared the question.
Yeah, I think we've covered mostly all the questions on equity debt allocation and how will we work in debt and the stock selection criteria and equity zone. Viraj, if you could quickly answer, what will be the expense ratio of this scheme compared to other schemes, similar schemes in the
It
market?
will be similar to other schemes, 2.25.
Okay. Paras, will we follow any technical analysis of parameters also when, while we are looking at the equity portion, or we will also look at PE and PB, etc.? I know this has also been covered, but in 30 seconds, if you could just quickly tell us.
So whenever we are looking at equities, we'll be looking at it purely from a momentum perspective. And momentum, as we showed, that there will be three ways how we identify momentum. So first is the absolute and relative momentum. Second is the regression models that we've applied. And third is the slope and angle analysis, which helps us to determine the strength of the momentum or strength of the trend. So a lot of data analytics and quant part goes into it, and also a few of the technical parameters are used to find out what kind of equities to be taken in the portfolio. I hope that answers the question.
So I think that's all. We've covered all the questions. I would request Viraj to kind of give us closing remarks and end this call.
Thank you very much, guys. I know it was a long call, but the questions were very interesting from all of you. Thanks to my entire team, and thanks to all of all the efforts that you have put into hear us very, very patiently. One final thing I will tell you, guys, till the time we are ignored about a particular direction or about a particular strategy, we can still say that I was not aware of it. Once we are aware of a particular strategy, which is the momentum-led strategy, where you can actually create a lot of alpha for your investors, and we still ignore it, that is a call that we are going to take to go against the market trend, because the trend of the market. So I'll just give you one final comparative number. Nifty today has gone up by only 1% in the past 4.5 months, closer to 2%. But the two passive momentum index today are at 20% and a 14% return during the same time frame. Now, till the time we were not aware of this particular comparative numbers, I can say I was not aware of it. But now that being aware of that particular number, and if we still ignore it, the question is still when can we keep ignoring the performance part of it? So it is your and my opportunity that we have created this product, and it is now that I urge you as the partner of Samco Mutual Fund, as a distributor partner, to allow us to take it to your clients and let them benefit from it, because as I earlier explained, the 3 P's are in our favor now: the product part of it, the pricing part of it, and our partnership. So thank you very much once again for your time. Thank you very much for the support that you have given us so far in the journey. I'm looking forward to double it from here on through this product and through this effort. Thank you very much.
Thank you. Thank you.
Thank you, everyone.
Thank you all for participating.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.